Hello, welcome to the European Open briefing for Wednesday, January the 31st. I'm Rafi Barajan, currency analyst at XM.com, and we're going to be having a look at what's happening in the currency markets today. So the US dollar continues to struggle this morning. It is heading back towards last week's three-year lows. It did briefly rise against the Japanese yen after the Bank of Japan increased its bond purchases in its regular market operation earlier today. It rose above 109 before falling back again. The euro is up this morning. Yesterday we had another set of decent GDP numbers out of the eurozone. The pound, having fallen below key levels yesterday, is back sharply up again. It's being lifted by comments by Bank of England Governor Mark Carney that the bank is shifting its focus back on inflation. And the Australian dollar came under pressure this morning after Australian inflation numbers disappointed. Let's first start with the dollar, though. We can see here in the chart the dollar index and the dollar yen. Both of them have been pretty much trading sideways since late last week, when the downtrend appeared to have halted, at least for now, after reaching three-year lows. We can see the dollar yen in orange here has been attempting to climb back above 109 level before falling back down again. It briefly rose above 109 earlier today. There was little reaction yesterday to President Trump's State of the Union address. President Trump focused his speech mainly on immigration and infrastructure spending. There was a little bit of relief that he didn't really talk too much about trade, and so that did alleviate fears about potential trade wars. But overall, it did little for the US dollar. We did have, though, much stronger than expected consumer confidence numbers. The Conference Board's Consumer Confidence Index rose much more than expected in January, but again, very little reaction to the data. Dollar index, we can see, has fallen below the 89 level. Dollar yen currently trading around 108.70. The yen is broadly weaker today following the Bank of Japan's decision to increase the number of bond purchases, the number of medium-term Japanese government bond purchases in regular regular market operation. It was expected for the Bank of Japan to do this as Japanese 10-year yields on Japanese government bonds came close to approaching 0.1%. Of course, the Bank of Japan policy is to keep that yield close to as zero as possible. But the main reason why the yen had been gaining recently, we can see here since late last week, apart from the dollar, the yen has been up against both the euro and the pound, as well as other major currencies. It's been risk aversion. Rising government bond yields globally has led to a bit of a sell-off in equities. Yesterday we saw the Dow Jones recording its biggest two-day drop since September 2016. Although today we are seeing some return of risk appetite. European stocks have opened higher. US stock futures are pointing to a positive open in Wall Street as well, though in Asia stocks were mixed. We also had comments from Bank of Japan Governor Haruko Kuroda and Deputy Governor Iwata. Both of them reiterated the need to continue with powerful monetary easing. Plus, we had the Bank of Japan summary of opinions of the January policy meeting, where although we are seeing growing discussion within the Bank of Japan board members about the need to eventually adjust monetary policy, overall they want to maintain the current policy, given that inflation is still some distance from 2% target. Plus, some members talked about the unintended signals from the Bank of Japan's earlier market operation earlier this month, where they reduced the number of long-dated government bond purchases, and that gave wrong signals to the market. So there were concerns about that. So all of that has helped the yen to weaken this morning. We can see the euro has strengthened to around 154 yen, and the pound has strengthened to around 135.20 yen. Moving up to the euro now, we can see it is back above the key 1.24 level. It briefly spiked to about 1.2460 yesterday. Eurozone GDP numbers showed the economy growing by 0.6% quarter on quarter, as was expected, though the prior quarter was revised up from 0.6 to 0.7%. So the annual we saw overall in 2017 Eurozone growth was the highest in a decade. Though other data out of Eurozone yesterday were mixed. German flash inflation numbers for January came in below expectations. So this shows that even in the Eurozone's strongest economy, inflation remains still some distance away from the 2% target. As we also had the economic sentiment index yesterday as well, which showed an unexpected drop in January. Later today, the focus will be on Eurozone flash inflation numbers. Moving on to the pound now, we can see the pound had fallen quite sharply over the past couple of days. Yesterday, it briefly dipped below 1.40 level to as low as 1.3980. It has made a dramatic turnaround. That mainly came on the back of comments by Bank of England Governor Mark Carney, who was testifying before the House of Lords Economic Affairs Committee. He said that as slack in the economy has been taken out, we move into a more conventional area of monetary policy, where the focus is increasingly on returning inflation to a target of an appropriate horizon. So this suggests that the Bank of England is ready to raise rates again over the coming months, especially if wage growth in the UK was to accelerate further. We can see the pound managed to rise above the 1.42 level before easing to around 1.4160. Plus, we've also had some easing of the political uncertainties surrounding Brexit and the UK Prime Minister Theresa May. Theresa May refuses to quit. She says she has a job to do and wants to get that done, and that she is not a quitter. We are reading some reports that the UK will likely reject the EU's current offer on a transitional deal, given some disagreement over some issues about that deal. So that will likely be coming up a lot over the coming weeks. But for now, the pound appears supported about 1.4150. Moving on to the Australian and New Zealand dollars, we can see the Aussie did come under slight pressure earlier today. We had weaker than expected inflation numbers out of Australia. Annual inflation came in at 1.9% in the fourth quarter versus estimates of 2%. Core inflation also came in at 1.9%. That is below the RBA's target band of 2 to 3%. So this suggests that the RBA is unlikely to be raising rates in the coming year, although markets are still pricing the possibility of one rate hike before the year end. We can see the Aussie did manage to pare those losses, currently trading around 0.8088 versus the greenback, and it's flat compared to yesterday's close. Also weighing on the Aussie this morning has been disappointing Chinese manufacturing PMI numbers, which came in below expectations in January. The Kiwi, on the other hand, has been able to benefit from the Aussie's weakness. The Aussie's weakness has spread to the Aussie-Kiwi pair, so that has boosted the Kiwi against other pairs, notably the dollar. It is up almost 0.8% versus the greenback at around 0.7384, having briefly climbed above the 0.74 level earlier in Asian trading this morning. Moving on to today's economic calendar, we can see the Australian data there, as well as the Chinese manufacturing PMI. German retail sales disappointed this morning for December. We've got the flash Eurozone inflation numbers coming up, as well as Canadian GDP, the monthly GDP numbers, and in the US, the focus will be Chicago PMI, pending home sales, and of course, the FOMC decision when the Fed concludes its two-day policy meeting. That's due at 19 hours GMT. That's it from me. Thank you very much for watching, and have a great day.